We've seen a real significant pivot in sentiment, and I think that sentiment really is, did the pendulum swing too far in May? Did we do too much damage? And now, how much of that can we claw back? And I certainly think over the last 6 days, we've done a pretty efficient job of clawing back about 74% of what we lost in the 6 weeks that we were down in a row for the Dow. So I think that what we're looking at here is a bit of a, not quite as bad as what we priced in over the course of May, and perhaps we need to get back to at least neutral territory.
Yeah, you know, we've got a special series this week. Today we're talking about corporate debt. Corporate debt's been piled on. A lot of that debt's being used to buy back stock, Art. So we go through these quiet periods where companies can't buy back stock. We're back in where they can. Is that part of the thesis, that companies are going to step in when the market falls and sort of support the market?
Yeah, I think that's part of it. Now, obviously, there has been a lot of questions about what the best use of cash is, whether you raise debt to have that cash in your balance sheet, or at these ultra low rates, or you're just throwing off cash. And dividends and buybacks have always been part of that. But recently, over the last 3 weeks, there's been a massive amount of cash being put into M&A activity. And I think that's as important as anything in what's driving this market right now. You'll notice yesterday we have that large aerospace and defense deal, and the entire space pops. We have a software deal, the entire space pops. So I think there's a halo effect to the use of cash in terms of M&A activity versus just buybacks.
You think maybe M&A then is that stool that's sort of underneath the market then?
It really feels like it. And people just try to extrapolate out to what is the next deal. Oh, if this is worth that, then perhaps we should be thinking about the value of this company this way. And I just think that that certainly helps the psychology.
And a lot of these deals, I don't want to say they're fat premiums, but they're certainly not skimpy. You know, so if you're willing to pay 30-40% above the offering, you know, above where the stock is trading, and maybe, you know, 8 times EBITDA,
right,
that's going to give a valuation basis to stocks.
It's going to change that multiple that you're using in your head to say how much is a software company worth. Like
or maybe the deal makers are being dumb. Maybe they're overpaying.
Yeah, but there is a scarcity right now. I think there's a scarcity of companies that are available to take out, to tuck in. And I think we've seen it only because companies have either stayed private for so long or have been taken out. We've never really known them in the public markets. Oh. So when we think about artificial intelligence companies, there's been something like 350 artificial intelligence related companies that have been taken out that you've never heard of.
You know, but I will say this as well, though. When you look at, we talked about it a little bit yesterday with Ellen Zentner of Morgan Stanley. When you look at the pool of stocks over the last number of years, it's shrunk. It just keeps getting smaller. Right. Either companies get bought or they're buying back their stock. That pool of assets shrinks. The number of buyers remains the same or grows. Right. And so everybody's chasing a smaller pool of assets. That could have a long-term floor under this market.
That's such a very good point, Brian. And literally, we've cut the number of publicly traded companies in half over the last 10 years. In half. So when you think about that, to your point, I think that's very important. And yet we still hear people saying we should use a 16 multiple for the S&P 500. And over the last 10 years, the companies that are in the S&P 500 are growing their earnings at a much faster rate than they were 20 years ago. So to me, I think that augurs for a slightly higher multiple.
So maybe we should change our thinking on what is a fair value or a good historical multiple, simply because there were 10 buyers going after 10 apples. Right. Now there's 10 buyers going after 5 apples. And they're competing for those. They're going to bid those apples up. Right. And that sort of seems what's happening. It's a massive story that not a lot of people are talking about.
Right. And to the same argument, when you think about buybacks, that's shrinking that same pie too. So share counts are down. So I think when you say to yourself, when a value investor comes up to you and says, well, wait a minute, the S&P 500 is trading at 17 times next year's earnings, I think it's okay to say, yeah, that's right. And I think that's good.